Hi, Tiffany Woodfield here. In this video, I'm going to cover 10 essential cross-border estate planning tips that will help you prevent costly mistakes. When you're a US citizen living in Canada, estate planning is critical because you often have beneficiaries and assets in more than one country. As a cross-border financial advisor, what I have found from speaking with hundreds of clients is estate planning is often overlooked. There are three main reasons you want to do your estate planning correctly and work with a professional. First, if you don't want the money tied up too long. Second, if you don't want the government excessively taxing. And third, if you want to make sure that your wishes are followed. So who needs professional assistance to do estate planning? In Canada, death is a major taxable event. It's as if you sold everything the day before you died. For this reason, everyone needs some assistance to do estate planning. Unless your estate is really small, you will always benefit from getting some estate planning done. If you're a US person living in Canada, it is imperative that you get professional advice. This is because there's so many more pitfalls that you could fall into. Now keep in mind this video is general in nature and estate planning is complicated, so I recommend you speak to a professional about your individual situation. First, trusts don't work the same in Canada as they do in the US. The most common mistake I see is people have a revocable living trust when they're living in the US. They have their assets like their home and investments held in the trust. However, because taxation is different of trusts in Canada versus the US, what happens when they bring this trust to Canada is it's not treated the same way and they're at risk of double taxation. For an IRA, you have more qualifying beneficiaries than you do with an RRSP. What this means is you can stretch out the tax liability, meaning that you don't have the tax all come into income in 1 year for the beneficiary. They can stretch it out for up to 10 years in the US. This makes it a great retirement account. When it comes to gifts, you have to take into consideration that gift of cash or an inheritance of cash versus a gift of an RRSP or an IRA is much different. The reason for this is with a registered account, you have the tax liability attached to it. What you need to understand is who's going to be responsible for that tax liability. Will it be the estate? Will it be a rollover? Or will it be taxed in the hands of the beneficiary? People mistakenly think rollovers are automatic. This isn't always the case, and there may be opportunities where you want the rollover to actually not happen. A rollover is when you take money from a registered account and roll it over to another registered account. The most common one is a spousal rollover. You're essentially deferring the tax. Now, there may be opportunities to be able to have that tax included in the terminal return. So some instances, you're going to want to have it in the terminal return, and sometimes you're going to want a rollover. I recommend that you speak to your accountant about this ahead of time. In general, I recommend putting together your team of cross-border advisors. You will want to work with a cross-border lawyer, cross-border accountant, and a cross-border financial advisor. When you're putting your team together, you may consider with your accountant that you have somebody who does tax preparation and someone else who specializes in estate planning. You may even want to have somebody who can be a professional executor for your estate. This is particularly important when you're a US citizen living in Canada. Charitable giving produces a tax credit, and a tax credit reduces the amount of tax you pay on your taxable income. In the year of death, the amount of eligible gifts that can produce a donation tax credit is increased from 75% to 100% of net income. You can also donate shares of publicly traded companies that have a large capital gain in order to reduce the tax that you owe. These can be donated in kind, meaning that you just donate the whole share. When the deceased passes away, net capital losses can be used against all sources of income. The reason that this is important is because it can reduce your taxable income, and we know in Canada, we usually have a higher tax at death. An election gives you options and flexibility. It's when you're telling the government you're electing to have an alternative treatment of a taxable event. For example, normally there's a spousal rollover, but you can elect out of this happening. There are additional elections that may be available to you, and it's important when you're doing estate planning to talk to your accountant about these. Most people understand the need to update their will when they move countries, but what they may not understand is if they move across the province, they also need to update their will because the estate laws are different between the different provinces. If you don't do this, you may find your will is invalid. This means that your estate could be distributed according to an established formula rather than following your wishes. An estate freeze in Canada is when you have a Canadian corporation and you want to transfer the growth to future heirs of the business. Let me give you an example. If you're the owner or the freezer of the business, what happens is you've had the growth shares in the business, and now what you want to do is freeze your current value and have any future growth in your children's names or the heirs of the freeze. The reason you might want to do this is if you wanted to reduce the taxable capital gains when you were to pass away or there's a future sale of the business. It also is an opportunity that you can expand the use of lifetime capital gains exemption, which reduces the tax for the heirs of the business as well. Now, before we wrap this up, let me answer some of the common cross-border questions that come up. A cross-border trust is designed to deal with the taxation and trust issues unique to Canada and the US. It helps to avoid the double taxation that commonly happens with a domestic trust. Although Canadian wills are valid in the US, they may not comply with the laws of the foreign jurisdiction. I would recommend that you get professional advice. There's no gift tax in Canada. However, what you do need to take into consideration is if you're a US person living in Canada, you may have to file and report this back to the US. Whether you actually owe tax in the US will depend on various factors. So what I would recommend is that you get proper advice on your cross-border situation ahead of time. If you're planning a move across the border or you're already living in Canada and you're ready to get your estate organized, please go to our website and schedule a 15-minute call with one of our cross-border experts. Thank you for watching, and we'll see you in the next video.